All right. Well, I am excited because we're going to be talking about the big lights at the end of the tunnel, the big shining carrot that people often talk about when they have a business, is what to do when you're no longer in the business. You just kind of, unlike having a job where you just go back to your whatever you're going to do next. When you have a business, you have a potential to sell it for a very lucrative exit. And so we're going to be talking about the concept of the exitpreneur. Super excited to bring on Joe Valley from Quiet Light Brokerage. So Joe, thanks for coming on and talking about all things exits.
Good to be here, man. Good to be here. Good to be back with you once again. I really appreciate you having me on.
Yeah, so this is a welcome back. You've been on the podcast before. We've done a Facebook Live together. We've done you were part of my expert masterclass series for some of the courses that I have. So you've definitely been a big supporter, and Quiet Light has been, I give you guys kudos because you guys have been a sponsor of quite a few things I've been involved with. So, and I've seen you guys not just with things I do, but out in the community, really helping to educate people with these type of topics, because it's kind of one of those things people don't really necessarily think about until they need to think about it. But the more people understand what's out there, you could potentially have a very lucrative exit.
Well, the problem is there's so much misinformation out there when they do talk about it that I'd had enough, right? So I've had literally over 8,000 one-on-one conversations since 2012 with entrepreneurs in the role that I'm in now, online entrepreneurs exclusively, about the potential exit of their business. And, with one conversation that may lead to, 5 more with that same person, you can't cover everything and they can't absorb everything. So after our friend Scott Volker's event in February, what was that, 2020, right? Before
September 19th.
September 19th
in
yes.
Fort Worth.
You're right, because with his book launch, I met his scribe and I decided I'm doing it. Finally, I've been trying for a while, right? To actually put pen to paper and write.
Nice.
And the way he did it just worked for me really well. So a year and a half later, here we are. I'm finally done with the Exitpreneurs Playbook, and it's going to take all the mystery out of, what it takes to get maximum value for your online business.
Yeah. And so that's awesome. So congratulations. So as people are listening to this, your book will be out, but as we're recording this, it will be coming up soon. So this podcast will air, which I don't think we actually use the word air. It'll go live, I guess would be the right word, on the 17th of June, which will be a couple days after the launch of your book, the Exitpreneur Playbook. And I love how the fact that you've now kind of taken everything that's in your head and put it onto pen and paper, so that folks have the playbook, so to speak, of how to do this. And I'm looking at with the corner of my eye, I'm looking at the table of contents, and I love that you've got the kind of sports theme of a game plan. And so we'll be talking here a little bit about what the game plan is for an exit. So before we get into that, just briefly, how do people let me ask this way, for folks who are not familiar with you, who are you and what do you do?
That's a great question, right? So you see some gray on my chin for those that are watching and not listening. I've been self-employed since 1997, and goodness, that's like 24 years. So, I've had some pretty good successes and some epic failures, like every entrepreneur I know. I took my last physical product business in 2005. I took it 100% online, and then built it up, took it through the best of and the worst of the economy, and sold it in 2010, late 2010, through a little company called Quiet Light Brokerage, where I'm now a partner. I went to work for Quiet Light in early 2012. Since then, I've sold about 100 million in online transactions personally, touched another $500 million through the team that we have of entrepreneur turned advisors. I've bought, I've sold over a half dozen companies of my own. I've seen people have incredible exits, whether it's, $140,000 recently, right? From somebody that just was ready to move on and had
Mm.
another adventure. And that $140,000 made an enormous difference in their lives, all the way up to 25 million. People that have come to this country with absolutely nothing. Well, not quite. $200 to her name, didn't speak English. And, 14 years later, she's, selling a business for just about 7 figures. So I've seen it all, Kevin. I've asked all the questions. I've seen the mistakes. I've seen the successes, and I get it. And it just couldn't share it all in one-on-one conversations, and I couldn't share it all in podcasts, no matter how many I did. So I needed to put it all there to make this the as Walker Dybel put it, the ultimate reference guide to selling an online business.
Awesome. Awesome. And one of the things you and I have talked about before is that for a lot of folks, the cash flow of, if you're growing and you're growing, you're constantly putting more money back into it. Your accountant tells you, hey, you've got all this profit, but you might not see it because you're spending all this on inventory. And so for a lot of people, the biggest payout they end up seeing is when they actually exit. So can you kind of walk through maybe a little bit more of kind of what is the vision? I know you said you've seen people with 147 figure or
Eight
multiple
it's hard to count
figure.
hard to count those zeros sometimes, but yeah.
Right. Exactly.
Yeah.
Exactly.
Yeah. The reality is that, if anyone in the audience is running a physical product e-commerce business that's less than 24 months old, they're not making a whole lot of money because they're putting it, assuming it's growing rapidly, they're putting all that money back in inventory just to keep up with growth. I sold a business for a couple, Brian and Janine, and they had a business that went from 0 to $5 million in revenue in about 3.5 years. They really weren't taking much out because that growth was so rapid. They just kept sending money to the manufacturer, and it was getting to be bigger and bigger dollar amounts, into the mid 6 figures in terms of inventory purchases. And that's stressful and difficult, and it puts you in a leveraged situation that's very, very scary. Their exit gave them 7 figures in the bank, peace of mind, confidence, knowledge, experience to do it all over again when they were ready at the time of their choosing and with the type of business and brand that they wanted to. And the key thing, without bootstrapping it with, credit cards and a home equity line and that type of thing. And that's actually how they got started, $100,000 in credit card line of credit to buy inventory for a business that had taken off. But the key thing really is to understand that if you want to get wealthy or you want to get comfortable, odds are the best way to do that is to sell your business. It's written throughout history that the wealthy don't necessarily buy and build and hold unless they go public. They generally sell. And that's what we're seeing with e-commerce businesses that are less than 4 or 5 years old. The most of the money is made on the exit. And the truth is, Kevin, we're all entrepreneurs, right? You, me, and everyone in the audience. And we get this shiny object syndrome where we look at different things and new adventures and things of that nature. We have an affliction called I can do that. And it makes us, try different things. We get bored. We need to move on. And because of that entrepreneurial spirit, we need to put an exit in the plans. Get trained for it, if you will, right? Sports analogy, train for it, so that when you are hitting a particular goal, you can exit and move on to that other shiny object syndrome. If anybody in the audience just loves what they do, still going to exit someday. You're going to sell, because you're going to retire. You're going to pass it on to your children. You're going to die. You're going to get a divorce. Your partner and you are going to get in a fight. Something's going to happen where you are eventually going to exit your business, and you should prepare for that so that you're getting maximum value. The only way to do that is to really delve into understanding the details of it.
Yeah, we'll dive into some of those details of the scoreboard, so to speak, to keep with the game plan analogy. Now, we hear about different people exiting businesses, usually at these very large scales. But think about like somebody like Elon Musk, for example. There wouldn't be a SpaceX or a Tesla, most likely, if you didn't exit out of PayPal. which, that was many, many, many moons ago that he exited out of PayPal, but he took that money and put it into another business and another business. And now he's like, digging tunnels or something. I don't know. He's always got his hands in some new venture, which he used, basically putting the chips on the table from his exit from PayPal, which a lot of people sometimes forget.
Yeah, and the other option there is you exit or you go public, right? So there are two things there to look at. The people that we know in this industry that have done really well, they all are thinking about an exit or they have exited in some way, shape, or form. And that exit may be them stepping way back and letting other people take on, and them just doing the things that they love, like podcasting, right? If we know anybody that just loves podcasting, they do that, and they've got a team that does absolutely everything else. Or people that we know that have given me some wonderful endorsements in the book. Even Gino Wickman. I'm gonna read it on the cover. If you know who Gino is, right?
I'm not sure I do.
He's the author of Traction, Entrepreneurial Leap. He's the founder of EOS, Entrepreneurial Operating System.
Gotcha.
He exited. I won't read the quote. He exited EOS recently. So everybody moves on to the next adventure. You just got to know how to do it. And the first thing you got to do is set a goal, right? And some of these things are really basic, right? And so for the first 5 years of doing what I do, I never asked people what their goal was, because I knew that they wanted me to tell them what the value of the business was. Now I ask. I've done this enough times where I ask, so I can gauge fairly quickly whether their exit is imminent or, it's going to take 6, 12, 24 months. So you got to pick a goal, and that's a dollar amount. It's not a multiple, people. It's a dollar amount. You don't put multiples in the bank. And then you've got to reverse engineer a path to that. And it starts with understanding what the real value of your business is. If you don't understand what the real value of your business is, you have no idea how close or how far you are from the goal itself. And that's where most people make a mistake, right? The virtual water cooler talk is generally wrong. And I see people totally misunderstanding what the multiple of their business might be, what range they're in, and completely understanding how to calculate discretionary earnings, and missing, and this is the key part, missing hundreds of thousands of dollars in some cases of Addbacks. And that boosts the value of your business if you're not doing it right. And then there are a billion basic things that they should be doing that they're not. And I've talked to over 8,000 people one-on-one, and the vast majority of them don't have sellable businesses because they weren't prepared.
Okay, gotcha. And that's something to definitely keep in mind. So, all right. So it sounds like for a lot of folks, today might not be the right day to sell the business because maybe they're not prepared for it, wherever the case is. But to your point, maybe 6, 12, 24 months or whatever down the road, they could be ready for something, really special. So like you said, there's kind of an end point, and then you reverse engineer backwards. So let's just reverse engineer from, just because it's a nice, healthy, big number that people like, let's say $1 million. So if you wanted to sell your business for $1 million, regardless of where you are today, what would be the reverse engineering you'd have to look at to get to that point?
Well, we have to actually see where they are today in order to know how far or how close they are to that. So you want to narrow in on the type of business that they have. So if it's, e-commerce with 50% Shopify type site and the rest on third-party platforms like Amazon and so on and so forth, we're seeing multiple rise right now because of the aggregators buying up mostly FBA businesses, but they're starting to realize that there's more fruitful opportunities if they expand beyond just FBA, and so those multiples are rising. So let's just go with a comfortable, safe, and this is the water cooler talk, 3-time multiple. So for at a 3-time multiple, you've got to be earning $330,000 in discretionary earnings in order to have that $1 million exit. But here's the key.
Got it.
One of the questions I will ask if somebody says, I'd like to sell for $1 million, I ask, does that include or exclude the value of your inventory? Right? Because your inventory, you're going to sell, and you're going to sell separately unless you sell directly by yourself to an aggregator. They're going to ask you to give it to them for nothing as a working capital peg. And we explain that in the book as well. But generally it's the sale of the business plus the landed cost of goods sellable inventory on hand at the time of closing. You should get paid back for the inventory dollar for dollar because it's an expense on your books. You could have $100,000 or $300,000 that you've put out there. You should get paid for it because you've all done all the work to get it, to your fulfillment center or FBA or something like that.
Because, and to the IRS, correct me if I'm wrong, they look at it for the most part like that's cash. Like it's not an expense in a lot of cases until you've actually sold it, for a lot of folks. So you're paying, that's money. So it's like if you had cash and you're giving them cash, you want cash back. Am I saying that right?
I'm not going to put my accountant hat on because
okay.
I fell asleep in accounting class when I was in college. I do it every day now, but you're going to get that money back in your bank account. It's out sitting there as an accounts receivable, and you're going to get that in your bank account. So if your goal is to exit for $1 million, you've got to be at around 3 to 350. Let's call it 3 to 400,000 in discretionary earnings. But then you've got to back up and say, okay, what the hell is discretionary earnings?
Yeah, what does that mean?
It, right? It's not net income, right? Because if you're running a business and you pay yourself $100,000 and your net income and you're on payroll, your net income is zero. It doesn't mean that you now have to get that up to $330,000 because your payroll's an add back. Your payroll taxes are an add back. So at the very least, you get $100,000 or so there on the discretionary earnings line, because you go net income, and right below that, once you export your P&L to Excel in a monthly view, folks, you've got to do an add back schedule, and your payroll would go in there. Your mastermind events would go in there. Your personal travel that you run through the business, through your car or your home office, these things don't carry forward as expenses to the new owner of the business. The simplest, what we used to do back in the day was call this, instead of discretionary earnings, we used to call it owner benefit. So much easier to understand. What's your benefit as an owner on the bottom line of this business? It's your payroll, it's your net income plus your payroll plus your mastermind event fees, your personal travel, your mobile phone expense, your cashback rewards on your credit cards. All of those things are basic add backs. And then there's really deep level, confusing third level ones that I go through in the book. This is with the 3 different levels of add backs, an entire chapter. I think it might be the longest chapter in the book because it's the most important one. It will make your eyes bleed sometimes. I promise you that, folks. So this is why it's better in a book, so you can keep going back to it.
Right.
But grab your drink of choice and scroll through it. It's the most important thing. I've seen people come to me after getting valuations and ready to sell their business, and they missed $150,000 in add backs. It's just,
well, and correct me if I'm wrong, $150,000 in add backs would be like, to use your 3x multiple, would be 150 times 3. Yeah. So that would offset by 450,000 of what they'd be getting when they sell, right?
Yeah. It adds $450,000 to the list price of the business. And it's a legitimate black and white add back. It's not math, and it's math and logic. It's not magic, if you will. Right. So the biggest mistake I see people make, especially anyone that has an FBA business, they've probably gotten at least 5 emails from the aggregators, right? The Boosted, the Razors, the Thracios of the world right now saying, hey, we want to buy your FBA business. We can close in 30 days. It's exciting. And, an opportunity to sell that shows up in your inbox is exciting. But the sad part for me, and I don't care if I make look, my income aside, people are selling their businesses for too little value with a terrible deal structure. And they're giving away a couple of months worth of inventory. It's cash out of their pocket when they do that directly. So we cover that in the book, how to negotiate with aggregators if you want to sell to them directly, all the different deal structures and formats that you can expect other than just cash. It's literally all in there. It's every question anyone's kind of asked me over the last decade, and put there in writing in detail.
Awesome. Well, yeah. So let's, now that we kind of have the reverse engineering, let's now get into like, what does the actual exit process look like? And I think you just kind of prompted what I think would be a good question is an aggregator. What is an aggregator, and how is that different than a broker? Because,
Okay. Very different.
oftentimes with like
Yeah.
real estate, maybe people have kind of concepts with what that might be.
Yeah. There's a broker and an aggregator are very different. An aggregator
Okay.
wants to buy your business. A broker is going to help you sell your business.
Mm,
So there's two different types of buyers, right? There's the institutional buyers, and then there's the individual buyers. Historically, there's been more individual buyers than institutional buyers. But a few years ago, a company called 101 Commerce kicked this idea off where they were going to buy 101 FBA businesses in 24 months. It was an incredible concept and idea. They failed. They didn't do it. They got to 13 and then ended up selling to another company. Then Thrasio came along and they crushed the idea, and they've got over $1 billion valuation right now. And they've
oh, wow.
raised over $1 billion as well. And so aggregator is a buyer. They're an institutional buyer. They're very well educated for the most part, professional, kind, nice people that I would love to have a drink and dinner with. And they've raised tens of millions, in some cases, hundreds of millions of dollars to buy a portfolio of FBA businesses. The individual buyer generally just worked hard and saved their money, and they're looking to buy one. Or in some cases, if they have good SBA qualifications, they'll be able to buy more with a cap of a total investment of $5 million. But the aggregators are, the model that they have is that they'll buy your business at 2.5 to 3 times, and they'll bring that into their portfolio of FBA businesses that is much larger, much more diverse. So much larger and much more diverse reduces risk and increases value. And in this case, they're going to get generally an 8 to 10 time multiple anyway, right? So they buy something at 2.5, goes into their portfolio, and it's instantly worth 10. It's a hell of a business model. That's how Thras started. They started actually at 2 to 2.5. Now with 50 aggregators competing against each other, they know that when they are looking at one of Quiet Light's listings, that they're going to have to, make a good offer and make the deal structure right, and that they're competing against others. So multiples are pushing up on these FBA businesses, well into the 3s, sometimes into the 4s. We saw one recently that was in the pet space with recurring revenue at just under 7 times, and not a big business in that case. So that's the difference between a broker. They're going to help you sell the business. The aggregator is going to buy your business at as low as a multiple they can with as little cash up front as they can, and bring it into their portfolio and instantly have 8 to 10 times value on it, with the ultimate goal of another exit themselves. The individual buyer is just me trying to buy your business at the best value that I can afford.
Interesting. Okay, so let's walk through a little bit about that, because that's quite the topic. And because when you were on my podcast, which was almost 2 years ago, previously, this wasn't even a topic. This seems to be more like in the last 6 months or so. I feel like that, like I've been hearing, maybe longer than that, I don't know, this topic of the aggregator and people going out and buying. Because when you start talking about firms that have raised $1 billion, you're talking about some serious money. And some of it is like, at least here in the US, it feels like there's a lot of like crypto's on fire. Well, actually the other day crypto kind of took a dive, but like crypto is a thing, real estate, all these places, like places where you could put money, like it keeps rising. So is it just one of those, someone somewhere with lots of money realized, oh wait, these online businesses could be a thing, and we could, like to your point, if we on its own, the online business might be 2.5, 3, 4x, but when you add it in with a whole bunch of others in a portfolio, because it's so large and it's so diverse with risk, that now it's worth 8x or whatever the case is. Is it just people are starting to figure this out now? Like where what's driving all this? I'm just kind of
curious. So look back in, I talk about it, I can't even remember the dates exactly, but let's call it 15, 16, 17. Selling an e-commerce business over 3 times was difficult. In fact, I used to round my multiple down on a business to 2.74. it would show at 2.7 online instead of 2.8. People
Mm.
were that multiple sensitive.
Uh-huh.
But, a lot has happened over the last decade, particularly in the last 5 years. Consumers' confidence, investor confidence
Hmm.
has grown dramatically in the online world.
Hmm.
And the whole, oh gosh, you can never buy something off of Amazon. Don't buy an FBA business because Amazon will just change the rules and your business will go away overnight. That sort of chicken little, the sky is falling kind of mentality, it's going away. Look, they're
Uh-huh.
very smart, very successful, very well financed investors that are perfectly okay buying an Amazon FBA business. As long as it's run right, for the most part, you're not going to have an issue and Amazon's not going to shut you down.
Hmm.
Happens occasionally. Those are the stories we hear about mostly, but it's just that we're all maturing, Kevin, right? So,
Hmm.
10 years ago, you and I had, less gray hair. The
I
businesses,
had more hair.
and you had more. The online business world has just matured. So the businesses that people are buying and able to buy are more mature. They're
Mm.
not fly by night, businesses that are 6 months old, 12 months
Hmm.
old anymore. They're mature e-commerce businesses, the
Hmm.
legitimate real brands that anyone can buy their products from anywhere in the world.
Mm.
That's new, right? Over the last
Hmm.
decade. So it took a while for the big investors to catch up to it and dip down, right? Private
Hmm.
private equity general stays in the middle market, 50, 100 million. Now they're sort of dipping their toes down in this little e-commerce space, right? In the sub $25 million range. It's a heck of a lot of money for the seller of that business.
Hmm.
For the private equity world, it's not a lot of dough. They don't want to waste their time on a smaller business in many cases, but
Mm.
they're starting to see the concept of the roll up, buy a bunch of smaller ones, and it instantly, instant equity. We're all just maturing. That's the bottom line. And the individual business owners out there, the key thing for them now, I think, is to understand what they have and what the value of it is, so that they're prepared for it. Because if they haven't gotten that email yet, they're going to get it. If they haven't thought about selling their business, they're going to. I was running a perfectly fine e-commerce business. And I woke up one day in early 2010 and said, God, I'm sick of this.
Hmm.
I'm working 20 hours a week. I live on the lake. I've got a pool. There's a beach. My kids are out there playing. My wife's at home with them. And I was unhappy just because of that entrepreneurial bug that I had. I'm not
Mm.
alone in that. I'm not special. There's, 90% of the people listening are going to come across that same day when they wake up and go, yeah, I wish I could do something else. So you just got to be prepared for it. It's exciting. It helps get the one thing I've learned in talking to so many entrepreneurs is that when you understand the value of what you have and
Hmm.
you have a goal and a target, those tough days that you have, and we all have
Hmm.
them in this world that we live in, get a heck of a lot easier
Mm.
because you're working towards something real. You're not just working towards, top line revenue and launching another SKU, and you're just on a hamster wheel most of the time. You're
Hmm.
working towards something real that will allow you to take 6 months off or 12 months off, or maybe the rest of your life, or just do something that fills your cup and make less money because you've got a whole bunch in the bank.
Gotcha. That all helps understand the vision and kind of what is going on in the market right now. I think it was YouTube showed me a video by had shown me a video by Dave Ramsey talking about what's going on with the housing market right now, that like people are getting all these big offers and whatnot. His take, which I think actually applies to this, was you don't want to be doing this alone. You want to have a qualified person helping you through the process, because there's a lot of, on the flip side, savvy money with real estate investors and whatnot. And so if you don't have an agent or someone in your corner who's not just an agent, but somebody who knows what they're doing, knows how to manage the situation, you're leaving a lot of money on the table. Would that be a fair thing to say in this type of scenario?
Absolutely. And this isn't a pitch to, use Quiet Light advisory services. When I sold my business, I was able to take some time off, and I decided, you know what, my kids are into Taekwondo. I'm going to go ahead and get into it. And I got into it, and
Okay.
I started to rise up through the ranks, and,
Mm-hmm.
I don't know, 4 or 5 belts in,
Nice.
and I thought I was pretty tough. Right. But it turned out that I knew just enough to be dangerous. Right. And I'm out there sparring with this fairly old gentleman that was fairly overweight. And I thought, I got this, not a problem. He kicked my ass. I was on the ground so fast. And that taught me, I mean, he's been training for a long time. And it taught me that I knew just enough to be dangerous. And the book itself, it will enlighten you. It will give you all the knowledge that you need to really get excited about an eventual exit, even if it's not a decade away, a decade down the road. Or if you set that goal and you march toward it and you're there, you can always move the goalpost. But you'll never be prepared for the emotional aspect of selling the business, because it's very emotional. When you are a week, 2, 3 weeks away from $500,000, $1 million. In one case, I had a client, I just bought business under contract for just under $9 million. He had a key employee that made a huge difference in his life. And his deal with her was that when he sold the business, he was going to buy her a house. So we're 3 weeks away, and she knew it. She was excited too. He had a lot invested. She was invested in the sale. It fell apart. Totally emotional roller coaster. The advisor in this situation, me, yes, toot my own horn here. We were able to get it back on the rails, right? And move towards closing. I kept him from getting too emotional and blowing up and making a scene with the buyer, you know, and I kept his emotions in check as much as I could and marched towards closing and got the deal done for him. And we did sell it for the same amount. It was just a hiccup, a scary one, but that happens in almost every deal. And what you're never prepared for are the emotions. The other thing, Kevin, is that you don't want to negotiate with just one buyer. That would be like, you know, everybody here's probably heard of and watched Shark Tank at one time. Imagine, you know, you're excited to pitch your wares on Shark Tank, and you walk into the tank and everybody called in sick that day except for Mr. Wonderful. You're not going to get a very good deal, right? That's what it's like to negotiate with, you know, one aggregator that might reach out to you via email. You really want to be able to put your business in great detail out to them after, of course, they've signed a non-disclosure agreement, but not just to the 4, you know, sharks that are there, but more like, you know, 400. That way you're really getting them competing against each other. And it's not just about the dollar amount, it's about the deal structure too, because that can make a tremendous difference in your how well you sleep after closing. You want to have that type of deal structure set in place as well. And we've all done this. We've all built and bought and sold our own online businesses, and now we've, you know, been helping other people hundreds of times with their exits. So, you know, yes, it comes at a cost, but I guarantee you will make more and you will have a better deal structure if you work with a good qualified advisor, whether it's Quiet Light or somebody else that you're, you know, committed to. That's fine. The book will help you prepare for all of that. And you'll actually know pretty quickly, if you really digest what's in the book and then you talk to some advisor that tells you certain things, you'll have a pretty good idea of whether they know what they're talking about or not.
Well, let's touch on that. So in the book, real quick, what are some examples of well-structured deals versus not so well-structured deals, I guess is the question.
Unwell structured deals?
Unwell ones that are sick.
Yeah. So sticking to the aggregator situation there, right? So, you know, they created something called a stability payment. If you Google it and I'm selling my business, what's a stability payment? You're probably not going to find it unless we've written an article already about it on the Quiet Light podcast, on the Quiet Light site. The Exitpreneur site doesn't have all the content up yet, but actually when this airs, it will. But a stability payment is essentially a way for the aggregator not to give you more money at closing, or the full amount of money at closing, because they're trying to save their money to buy more businesses. And what they do is say, let's say it's that $1 million exit, right? They'll say, we buy with cash, we'll close in 30 days. And then the LOI says they want 2 months worth of inventory for free. That's their working capital peg. You should get paid 100% for that, by the way. And the other is that they're going to keep 90% of it in escrow or wherever they want to keep it. And so they're going to keep, 25% generally is what they look for. So they want to hold back $250,000 for 12 months. and the way it generally reads is, as long as revenues are 90% or greater 12 months after closing, as they were for the 12 months prior to closing, they'll release that $250,000. And that's what they're going to put out there for you. It's acceptable to a lot of sellers, but it's to me, it's unacceptable that it's 90% and that's it. Because if it's 89.99%, you lose $250,000.
Oh, gotcha.
So you want to go with, if you're okay with that 90%, then you can say, okay, well, if it's between 85 and less than 90, it's going to drop to 200. If it's 80 to 85, it's going to drop to 150 and things of that nature. So it's a sliding scale. And then you want to reverse that and say, all right, well, if it's 100%, then I'm going to get $300,000. If it's 100% to 105, I'm going to get 350, as long as it works for both.
The risk goes both ways. Yeah.
It goes both ways. The other thing is earnouts, right? So they're really starting to push for the earnouts now. And an earnout means you're going to get paid a percentage of, they're going to shoot for profits, over the course of a business with a cap. Never, ever, ever accept a letter of intent with an earnout as a percentage of EBITDA, of net income, or even gross profit. Because to me, they're all fuzzy numbers and easy to manipulate.
And what is an earnout anyway? Is that you're earning your way out of the business?
Yeah. So instead of giving you $1 million in cash, I'm going to give you $700,000 plus, 10% of profits up to $300,000. Right. And so if the business grows rapidly, you get paid quickly. If it slows down, it'll take longer. It protects the buyer's interest and keeps you vested in the business so that I can call you and you can help me. But you should never accept an earnout, in my opinion, of the bottom line, and just go with the top line. Instead of 10% of the bottom line, the same math would be maybe 2% of total revenue. They can't manipulate total revenue numbers.
Right.
Manipulate the bottom line numbers.
Right, because once you hand over the business, you're not in control of some of these things that maybe they change the marketing strategy, whatever. And this could be anyone, well-intentioned, but sometimes
they're all
well-intentioned.
I've seen people, be due, a $300,000 payout if they hit a certain amount of revenue at a certain period of time. There were a couple of different benchmarks. So eventually they hit it, but that first benchmark was not reached because the aggregator that bought the business ran out of inventory. They were like 93% to the goal. And then 3 weeks prior to closing, they ran out of inventory, right? You think that these people have so much money, they're never going to run out of inventory, but they're just learning. They're growing so fast that they're hiring people that are not owners and are not passionate about operating the business. And they ran out of inventory. So my client missed out on, a $300,000 payout. They got it. It just took another 3 months. But, now we put clauses in there that if you run out of inventory for any 2-week period on XYZ SKU, all bets are off. You just pay me. That really holds their feet to the fire to make sure they run the business true.
Okay.
Yeah.
Well, it sounds like, bottom line, there's a lot of moving pieces with selling a business. It could be something that's very profitable for folks, regardless of whether, I know we used the $1 million, exit is just for the sake of
simple math. Yeah.
Simple math. Exactly.
Yeah.
But you gave examples, there were on both sides of that, higher and lower. So if somebody, regardless of where they're at, they're just starting out, they want to kind of plan at the business, maybe exit one day, or they're thinking maybe the next 6 to 12 or 24 months, I want to exit out. Where can they go to, get your book and learn more about this?
They can find it at exitpreneur.io. And that'll give a link to buy it on Amazon. It will give you a lot of other resources. We've got a partner page with e-commerce bookkeepers, tax advisors, attorneys, lenders, SBA lenders, working capital lenders, so you can buy more inventory, all that at exitpreneur.io. And then, of course, just go to Amazon and just do a search for Exitpreneur, and you will find it there as well.
And we'll make this simple for folks. If you go to maximizingecommerce.com/exit, it'll go straight to the page. So between now and the time that this goes live, I will make sure that link is there as well. So, and then that will also be in the show notes. So definitely go check that out. You can get it on Kindle. You can get this on other type of
Yeah, there'll be
media.
paperback, Kindle, and a hardcover book as well. I haven't done the audio version. People are already requesting that.
Dude, you should.
But the studios were so backed up that we couldn't get into there to record. So that'll happen, and it'll probably happen with me reading it myself, so that I can get it done for folks.
Yeah, definitely. I think people would like that. I think you have a very good way of explaining these things and making it seem very accessible. And I think sometimes those little authored notes that get kind of like, added in, I think would be incredible to the process. And so I will be purchasing the book on June 15th, as well as whenever it comes out on Audible too, because I'm an Audible junkie.
Awesome, man. Appreciate it.
Cool. Awesome. Thanks so much, Joe.
You bet. Glad to be here.